A modern e-commerce platform processes tens of thousands of transactions every hour. The sheer volume and velocity of this data leaves zero room for manual oversight. When data corruption or a processing failure occurs, it rarely happens on the user-facing storefront. The checkout buttons usually work perfectly. As this graphic of abstract gears and analytical tools illustrates, the true vulnerability lies deeper, within the automated application interfaces, or APIs, that connect disparate internal modules. Today, we are auditing a specific critical interface, the connection computing sales in the order management system and routing the final payouts to the merchant ledger. If this connection drops a packet or miscalculates a rounding rule, money disappears. Malicious actors also target these connections to inject unauthorized payloads. Because these transactions move instantaneously in the background, standard manual UI reviews are entirely insufficient. We have to execute a highly technical, data-driven audit of the interface itself. To empirically prove an interface is functioning correctly, auditors rely on an evaluation framework known as the 4 pillars of interface testing. This standard breaks down completeness and accuracy. Input controls ensure data isn't lost or altered. Processing controls assure precise execution. The execution of transaction section details system cycles like replenishment. To ensure data integrity across these multi-stage steps, we test run-to-run totals. The third pillar is security and authentication. Even if data is complete and accurate, we must verify unauthorized systems cannot inject fraudulent records. The fourth pillar covers resiliency and error handling. When systems fail, the interface must track the exceptions instead of simply dropping the data. An interface is only reliable if IT application controls, or ITACs, are operating effectively across all 4 of these distinct vectors. We begin with Phase A, the test of design. Before pulling any data, we have to map how management built the system to work in theory. You do this by acquiring the interface control document, or the API specification, like a Swagger or OpenAPI file, directly from the system architects. Look at this audit guideline document covering ERPs. Under the Purchasing and Payable section, it describes exactly how purchase order data is copied from the purchasing module directly into payables. Your job is to verify that this mapping occurs automatically, system to system, without a human downloading and uploading a spreadsheet in the middle of the process. During these walkthroughs, as highlighted in the risks section here, you actively look for vulnerabilities in the design, such as the ability to use unapproved vendors or process unauthorized requisitions. You also evaluate the automated error rules. If the payables module goes offline for maintenance, you need to know exactly how the purchasing system queues the data for an automated retry. To prevent internal fraud, the design must also mandate dual control over sensitive fields, requiring a second set of eyes before master data like bank routing numbers can be changed. Validating this system design establishes your baseline. If the module integration logic is flawed from the start, the transaction data is compromised before it ever reaches the financial ledger. With the design validated, we move to Phase B, substantive testing. This is where we gather empirical evidence, beginning with a reconciliation test for completeness. You start by extracting an end-of-month data sample from both the origin, the order management system, and the destination, the merchant payout ledger. This audit checklist outlines the exact risks we test for at the ledger level, specifically calling out the failure to perform regular bank reconciliations and the posting of duplicate journals. We load both datasets into an analytics tool using SQL or Python and execute a join command based on a shared unique identifier, like the transaction ID. As we can see in this database visualization, the join reveals 14 orphaned records. These are transactions that successfully recorded in the sales system but never appeared in the payout ledger. This represents a total breakdown of the run-to-run totals. The processing controls failed to ensure the ledger maintained a complete record. Looking back at our audit checklist, we also have to confirm the query asking if journals are only posted once. A duplicate entry is just as dangerous as a missing one. Finding these orphan transactions proves the interface lacks atomic data transit, introducing a massive risk to the organization's financial reporting. We then test the second pillar, accuracy. This involves recalculation testing to verify the interface's automated business logic is executing the math correctly. We pull a specific sample of 25 transactions, reference the merchant contract terms, and manually calculate the expected net payout for each one. We also inspect the underlying master data settings that impact these calculations, looking specifically at price controls and mandatory reference document settings. If those master controls are somehow bypassed, an employee or an automated glitch could process erroneous credit memos or return adjustments, distorting the final payout. We then compare our manual calculation directly against the system output. As this diagram shows, when the formula for gross sales minus commission and fees matches the system's net payout perfectly, the test passes. This recalculation ensures that the core processing controls have not been quietly compromised by logic flaws or improper inventory valuation settings. Next, we evaluate the error handling pillar by asking IT for the system logs showing specifically failed transactions. We need to verify that when bad data hits the API, it isn't deleted. It must be routed into a secure dead letter queue for a human operator to review and correct. We also audit the operational health of the interface. This IT audit guideline lists the key metrics to review, pointing specifically to defect rates and response time. If a third-party vendor manages the interface, we check this same documentation for operational clauses, focusing on the time to implement new functionality and the associated incentive and penalty clauses. We also test for item potency, the system's ability to recognize and reject a duplicate invoice number if a network glitch causes a message to send twice. Monitoring defect rates and enforcing strict rework controls ensures the processing environment remains stable over the long term. After executing the tests, we enter the reporting phase. Technical failures must be translated into risk-oriented business language. You present the exact evidence. Your data test identified 14 dropped transactions, resulting in a $12,000 variance for the month. You articulate the exact risk. The interface lacks automated end-to-end reconciliation. Without it, the company faces merchant disputes and regulatory fines for inaccurate financial reporting. Executives allocate their budgets based on quantified operational threats. Answering the "so what" question with hard numbers is the most crucial part of your audit report. Finally, you deliver the Management Action Plan, or MAP, outlining the required remediation steps. The engineering directive is clear. The development team must implement an automated, nightly script to reconcile total transaction counts between the two databases. The operational directive follows. The finance team will receive an automated dashboard alerting them to any variance exceeding $0, with a mandate to investigate within 24 hours. Modern architectures rely entirely on automated data flows. Robust IT application controls allow these complex systems to operate safely at scale. Auditing these interface pillars, completeness, accuracy, security, and error handling, is the definitive line of defense against catastrophic systemic failure.